If you're into trading, especially futures trading, then chances are you've heard of the term leverage before. But do you know how leverage actually works? Do you know how to use it on Binance? Well, in this video, we're going to take a look at what leverage is, how to set it on Binance, isolated versus cross-margin, and lastly, some tips on how to use leverage effectively. So let's jump right into it. First off, we need to talk about what leverage actually is. Leverage allows you to control a larger position with a smaller amount of capital. For example, 10x leverage means a $100 margin can open a $1,000 position. How to set leverage on Binance Futures. First, go to derivatives greater than USDM futures and choose your trading pair. Next, set your leverage by clicking the leverage value near the order panel. You should see a slider or an input box appear where you can adjust it from 1x to your desired level. Then confirm your selection, and that's it. You've successfully changed your leverage. Now, remember that leverage is pairs. Changing it for BTC USDT won't change it for ETH USDT. So if you trade both of them, make sure to set the leverage for each pair individually. Before we dive into the risks of leverage, let's talk about the difference between cross and isolated margin. When you first deposit funds into your futures account, they will be available in your futures wallet. From there, you can select either isolated or cross margin when placing a trade. Here's the difference. Isolated margin. Only your margin for that specific position is at risk. Any other positions or assets in your account are safe. This is the default setting when you open a new position. So if you're a beginner, this is probably the setting you want to stick to. Cross margin. All funds in your futures wallet are at risk. So if one of your positions is liquidated, all of your assets are at risk of being liquidated as well. This is a riskier approach, but it can prevent liquidation if other positions in your account are profitable. To switch between the two, simply click on the margin mode button near the leverage setting. Select isolated or cross and confirm your choice. Now that we know the difference between isolated and cross margin, let's talk about some of the risks of using leverage. First and foremost, never use leverage to gamble. If you think leverage will make you rich, you're going to lose money. The house always wins. Okay, so what actually happens when you use leverage? Let us say you have 10x leverage and your margin balance is $100. Here are some quick tips on how to use leverage more effectively. 1. Don't use high leverage just to make more. Always set stop loss to limit downside risk. 2. Keep your margin ratio healthy. This is the amount of margin available for your position divided by the amount needed for the position. So if your margin balance is $100 and you have a position size of $1,000, your margin ratio is 10%. If your margin ratio falls below 10%, you could be forced to liquidate. We recommend staying above 50 to 70% for most situations. 3. Use small position sizes with high leverage. If testing, for example, if you have $1,000 in your account, don't put all of it on one 100x leverage position. Instead, break it up into smaller positions with higher ratios of equity to position size. 4. Use low leverage for safer long-term setups. If you're a beginner, it's best to start with lower leverage while you're building experience, and that's it. That's how you use leverage on Binance Futures. Hopefully this video was helpful and you learned something new. Remember to trade smart and stay safe out there. Thanks for watching.